Welcome to Views from the North, a Canadian rates and macro podcast. This week I'm joined by Joel Prussky, our OIS and cross-currency trader. This week's episode is titled, It's All About Inflation. I'm Ben Reitzes, and you're listening to Views from the North. Each episode, I will be joined by members of BMO's FIC sales and trading team to bring you perspectives on the Canadian rates market and the macroeconomy. We strive to keep the show as interactive as possible by responding directly to questions submitted by our listeners and clients. We value your feedback, so please don't hesitate to reach out with any topics you'd like to hear about. I can be found on Bloomberg or via email at benjamin.reitzes@bmo.com. That's benjamin.reitzes@bmo.com. Your input is valued and greatly appreciated. Joel, welcome back to the show. You've been on a number of times. You were my second guest to come on. I looked back at my old podcast today because I thought to myself, from having Joel on, we've had this, meaningful sell-off in rates. The credibility of the U.S. government, of treasuries, has come into question. And I've thought to myself, well, these are things that Joel was talking about years ago. And then so I went to the podcast page and I looked back and I was like, holy crap, the first episode was in 2020. And I was like, wow, 5 years is a long time for starters. But I actually listened to the episode. So you were on second. You were the second guest I had. And I don't think it was right on, but pretty close for a lot of things. And future episodes, which I didn't, or episodes after that, which I didn't listen to. But I do recall you being perpetually bearish on duration and on treasuries in particular on the back of the fiscal situation. So kudos to you, Mr. Prussky, for calling it right. People just had to wait a little bit, I guess, for that to come to fruition, but it was always a matter of time.
Well, thank you, Ben. And it was a big term macro view anyways. I always like to think, the next 20 beats might be one way, but the next 200 is the other. Also, I wondered, you have way too much free time.
Why? I did it this afternoon when I was after the bank. There wasn't that much left to do for me. I did listen. I was just curious on what you had actually said. The sound quality was not great because it was at home at the time,
right?
Which made it extra interesting. So
yes.
We've come a long way since then. Luckily, we're all in person now, so that's wonderful, hunky dory. You said it was a big macro view. What's the big macro view now? I think it's a much harder call to make where the next 100 or 200 basis points is. 200 especially. 200 I'd almost have to say on the downside, not the upside. 100 I don't know, flip a coin. But even like in the long end of the US, I don't know if we can go 200 basis points lower, quite frankly, given what's going on. Like something has to fundamentally change in order for that to even come close to happening.
So, having been around a little while, and for those of you who don't know, I did just celebrate my 38th anniversary at the BMO on Monday.
We won't count how old that is. Not. He started when he was 8.
But I've been around for a few crises, some of which were the referendums. And all it really takes for a massive repricing of a security is a lack of buying. So I would say that we can't easily conceive of another 200 beat backup in long treasury yields. But I actually can envision it. I think there's a global debt problem that needs to be funded, and I think there's a huge amount of other countries competing for your debt money. And Germany took off the fiscal brake. Europe's spending money. The curves are steep. So if the U.S. was to do or continue to do, in my opinion, some kind of silly things, a lack of buyers could move us 50 or 75 in a heartbeat. And I think ultimately 200 would be impossible because I think the Fed would step in. I think you'd have a situation where the Fed would say they would bankrupt the U.S. and there's huge knock-on effects of 7% long rates. But I could envision the trust moment in the U.S. happening if they pass this big beautiful bill, for example. Like there's just too many other places to put your money these days. And Japanese yields were negative or zero for the better part of a decade plus, and now they're substantially higher. So, you have to compete with that now globally.
Yeah, we're all substantially higher, in fairness. But
the Canadian long yields are almost 150 beeps through the U.S. So thank God we have enough pension fund and investment managers who are willing to buy that stuff, who are relatively price independent. Because if we ever had a reasonable amount of supply out there, I don't know where we would find a home. I surely don't think it would be 150 through the U.S.
I don't know about that. Like the relative supply dynamics still play a pretty big role here. Swap spreads tell a different story, I guess, as well. Like there's just that many more treasuries rather than Canada's for the market to absorb. And they have a disproportionate relative to Canada amount of longer term, longer duration debt. And so you can see that pretty clearly, actually, if you look at their interest payments as a share of GDP. They're above 4% now.
And what's ours when we
Canada's
include,
at like 1.7.
when we include the provincial?
That's I can't do that on my little fancy screen.
No, but I mean, I
doubles.
think that's probably a closer comparison.
It probably doubles in a double plus change. So like 3 and whatever, 350, maybe 375. I would just be off the top of my head guess. But still, the U.S. is like materially higher across. So that is a bit challenging. You convinced me a little bit. 200 higher. I mean, the Fed is my issue, and seeing interest payments explode like that as a share of the economy would be a real problem for the U.S. Whether that gets them to kind of shape up and figure their stuff out fiscally, I don't really know, but we'll see. The reason I brought you on in the first place was to talk about the Bank of Canada. So I kind of went on a tangent there just because I had to go down memory lane. We had the bank this morning. They held as expected. I think they did kind of exactly what we said they would, which is always nice for me. It's nice when I do my job well. It doesn't always happen. I'm wrong a lot. Sometimes I'm right. Today was one of those days. Good for me. Right down the middle, I think. The bank said they kind of want to cut at this point. They want to be cutting, but inflation is not allowing them. Where does that leave you on the bank? Where does that leave you on pricing? What are your broader thoughts here on the Bank of Canada?
So, I have to agree with you. I think this one was pretty much as expected. I think initially it was kind of taken to be a dovish hold because of the headline that came out, which suggested that they wanted to cut. But of course, when you read the rest of the sentence, it's like, we want to cut, but, or if. And really all we did was reprice the 3 beeps that was in June down to July a bit and SEP a bit. And at the end of the day, like the December meeting didn't budge. And we're still priced for like, I think 238 at the end of the year, which is, I don't think anyone has a big beef with that. It's 1.5 cuts, and I think the banks made it clear that their bias is towards cutting rates and that they are well aware the economy is slowing, but they have no choice at the moment because they have a single mandate and they have to fulfill it. And they also risk losing credibility if they don't.
Over under 1.5 cuts by the end of the year.
I don't know. Was inflation going back to target or not? Like, if inflation's...
I'm asking you
if
your
inflation
opinion at
is
this point.
sticky, I don't know. You have better inflation models than I do. I tend to think that shelter costs are going to come down hard. And I don't know the math of how that affects the median and the mean, but I think tariffs are raising things. Like, I think look, if this was any other time in history, we would already be at 2%.
Yes.
These guys would be, because they love cutting and they think that 2% is a high rate, or the market tends to think 2% is a high rate. But we're just coming off the worst inflation scare of our lifetime as traders, most of us. And, the Bank of Canada just simply cannot do anything until they see those things heading in the right direction there. Even if they were unchanged last month, maybe we'd have a little more runway, but they went up, and that's a problem. And we don't put everything on one meeting. But the bank has basically said, we know GDP is going to be crappy. We know unemployment is going to be crappy. Like we know all these things, and we need to wait for inflation. So inflation, to me, is all that matters. Like, hopefully we can sleep through the summer, play a lot of golf, and show up on the 2 inflation days.
I'm in.
Because
for all of those things.
Because I think there's a limit to how much the market can reprice on weak data, X inflation data.
So I think it's worth unpacking as to why that actually is. So you talked about the fact that we are coming off of the worst inflation scare in a generation. And it's not just that it was the worst inflation scare, it's that central banks were caught completely off guard. And he even admitted today that if we had predicted inflation better at that time, perhaps we would have better been able to control it. And to some extent, he's right. To some extent, he's wrong, because there were factors well beyond their control. You can't control supply chains, but you can also not facilitate the government largesse that occurred over that period and not buy bonds the way that they did and just facilitate the monetary expansion, as it were. But the fact that they got it wrong tells you that their models got it wrong. And if their models got it wrong then there's no guarantee their models are right now.
Well, we know their models aren't right now because inflation shouldn't be ticking up based on the output gap.
So I don't know about that. So I mean, one of the things I would talk about last year is that inflation is one of the is the most lagging indicator. It's not one of the most. It is the most lagging indicator. It will be the last thing to move pretty much every time. And if that's the case, like go back to last year, the second half of last year, I turned pretty bullish on the economy. I was right, except for the stupid tariffs that completely threw me off the rails. But the economy was doing better and things were picking up. And I think we're seeing that inflationary impulse now to some extent, and the Canadian dollar weakness that we got over the prior over the 6-month period between kind of Q4, Q1. I think that's kind of what is flowing through at the moment. I expect to see the weakness in inflation coming over the next 3 to 6 months because you have wage growth slowing the way that you do. That will feed through. I think that part's pretty clear, and it's probably going to get worse on that front. It's hard to believe the labor market's going to all of a sudden firm up and the unemployment rate's going to stop going up immediately. Like there's probably still upside there. And demand, I expect, will soften off with the labor market. And so that also means softer inflation. And then you mentioned housing, which is huge. That's going to be a drag on inflation. I mean, there's no way that doesn't continue to slow unless they cut a couple more times, and then I'm happy to reevaluate. But all of those things point to lower inflation. But
in the future.
But is that certain? No. Can they afford to make a mistake? Definitely not. And if you can't afford to make a mistake, you have to wait.
Right.
Unless things are completely falling out of bed. The unemployment rate goes up another half a point in a month or 2 months or whatever, something like that, then we have a different conversation.
Well, hold on. So let's say, like, we know their models weren't good because they didn't predict the inflation of 2022, 2023. We suspect our models aren't great now because they would have already expected inflation to be heading down, and it kind of didn't, and head up again. If they're really only an inflation targeting central bank, can they trust the models even if those inputs start to turn and measured realized inflation doesn't turn yet? Like, are they willing to go all in? Because essentially that's what's happening. At some point they have to say, if things get as bad as you just said, so another half a point in unemployment rate, and anecdotal, like, I mean, they have the BOS and all the other stuff, like they know what's going on out there. Can they afford to say, in spite of our models not being accurate of late, we believe enough that we're going to cut rates even with inflation at 3% and not heading lower? And I think that's a dilemma. I'm not asking for an answer.
I'm going to give you an answer anyways. I don't think they have to go all in. All in for me implies cutting down to some very low level. What they can probably do in that case is just move a little, and kind of, which is what they're doing now, is just be much more incremental and not be nearly as aggressive, and take things kind of a meeting at a time. And as you get information that gives you a little bit of confidence that you have this weakness in the economy and inflation is not accelerating at this point, I think you can have some confidence that, like, the laws of economics do still work, and you are going to have inflation pull back at least a little bit. It limits how far they go. That is the one thing I'll say. Like, that, it tells you that they're probably for sure not getting below 2% in that kind of scenario, and even that probably a bit of a stretch.
Let's say inflation starts behaving, right? Behaving and starts heading towards their 2% target, right?
Heading.
Like, the direction.
Heading and being there is two different things.
They can't wait for it to be there, and they won't if everything else. And that I understand. Heading is the right thing. So inflation stops going up, and median and mean start trending down.
Yep.
So let's say you get a 2.9 or 2.8 next time, and you're like, okay, good.
You will get
it's
that.
It's in the right direction.
Yep.
Then we get another one, and it's 2.6, and they're like, okay, now we have confidence it's heading back down. You know, what is the floor for rates if that's the case? Like, I mean, I don't think we're ever going to zero again.
I think it's still only around 2%.
Yeah, 1.75 maybe lowest.
Yeah.
But 1.75 should be the old zero.
I kind of buy that. Something in that ballpark. I mean, if there's a super emergency. But it depends what the fiscal side does.
So exactly. So what's to stop the fiscal the next time? The only thing that handcuffs fiscal is the bond market's ability to take the debt down.
Yes.
Like, right? I mean, the only thing that we know that stops fiscal is the bond market saying no mas. And that's kind of what's happening in the US to some extent relative to Canada.
Yes.
Right? But if we started getting sloppy, we would be in a same situation, and we could see rates move substantially higher led by the long end.
Yes.
And a substantially steeper curve, which would be a message saying, hey, wait, what are you guys doing? So
Yeah, that's a long way from here.
okay, but we're spitballing here, Ben.
Yeah, I think policy there's probably a lot more recognition on the monetary side that the fiscal side is extremely important. And you
Now,
can know,
you mean?
now than the past 15 years. You are no longer independent to some extent. Like the fiscal side matters more at this point. Actually, I would argue the fiscal side matters more than the monetary side. I think both sides of the equation know that. The government knows that as well, especially given who the prime minister is at the moment.
Is that because we ignored asset inflation for 20 years?
I think there's a lot of reasons why.
Okay.
But I think the pandemic made it clear.
Right?
The pandemic made it clear
Sure.
that fiscal matters, and it matters a lot. And if you facilitate that,
Right.
you're in for a world of hurt, which is really not shocking when you kind of print a whack load of money and give it away to people to spend, that it causes inflation, which is...
Except in my view, that we always had way higher realized inflation than we were showing, because in the U.S. it's housing, healthcare, and education. We have relatively low education costs, although they've still been accelerating at a really relatively higher clip. Mm-hmm. Housing has been through the roof.
Yep.
And asset prices have gone through the roof. So if you're a 25 or 30-year-old starting out now, the world you look at looks extremely expensive compared to when I was 25 or 30 years old.
Jeez, it's expensive compared to when I was 25 years old.
Right. So to me, there was always this inflation. It just wasn't showing up in CPI. But from a life inflation perspective, and the Fed said they were doing their job and the bank said they were doing their job, they really weren't. I mean, let's say, average salary to house price, use that as a metric.
No, not even close.
But to me, that's way more important whether a TV costs $800 or $600. But, I think that they all looked through that. And then when COVID hit, and then you had the printing of the money, it just turbocharged. It was basically 2 feet on the gas, full speed, and inflation started showing up in other places other than the usual places, which it had been showing up for 15 years. That's kind of my hot take on things.
The caveat for me there is part of the reason that you had these asset price increases. Rates were falling from 1980 until 2020 in a straight line. And I mean, you discount the cash flows, do whatever you want to do with it.
Okay.
It means higher prices.
Well, wages weren't keeping up.
Well, so it did I agree with you. Like home prices we're rising for a number of years, well above wage growth. But part of that is just affordability. It's wages plus the change in rates. And so wages, so one of the issues is I think a lot of the time people look at housing, especially in Canada, or in the US as well, and say, okay, well, housing should rise kind of at the rate of inflation, so like 2 to 3% a year. That makes good sense. But no, it shouldn't. It rises at the pace of wage growth. Wage growth is more like 4 to 6%, and that is way faster compounded. Right.
Yeah.
It's double and then some when you're compounding over a long amount of time, and then you supercharge that with rates going from 25% down to effectively zero. What do you think's going to happen? The problem was that rates went all the way down to zero and stayed there, and that really pushed things. I think that was, from my perspective, like a decent chunk of the conversation narrative around the housing shortage and unaffordability in Canada was driven by the rate environment, not by a lack of supply. There is a lack of single-family detached houses.
Sure.
I am not debating that point. There are way too many condos. So if you tell me there aren't enough units, I'm sorry, I'm not really going to believe you. There aren't enough units that people want. That part's perfectly reasonable. Nobody wants to live in a box when they come to giant Canada where we have tons of space. But that's the way that we've decided to build our country, for better or worse. And rates were a big driver of that. And so I get the inflation argument that assets went up, but part of that is just rates were a lot lower, probably lower than they should have been. And now we're getting the other side of that.
Right.
Home prices are going down.
Right.
And they're probably either going to go nowhere or slightly lower for the next number of years, especially in Toronto and Vancouver. And we're adjusting.
Yeah.
And so...
But also, don't you think there was a shift to you went from buying the home you could afford to buying the home whose payment you could afford?
Yes.
Like, I think there was from from my generation to subsequent generations, there was a bit of that mentality, and that's a function of low rates, right?
Yes,
absolutely,
entirely.
But it's sort of like, well, I can pay this much a month, so let's just,
I'm a super disciplined guy, so I did not go down that road.
Okay.
We bought a house we could afford,
Right.
and our payments were not stretched. In fact, they were pretty low. In retrospect, I should have levered up a ton. I'm conservative by nature. Probably because my parents are and her parents are, and I did not grow up in a super wealthy household. So it's like hard work, and then you earn your money, and then you pay down your mortgage, and then you go from there. And so that's where we are. But that is entirely the way it is. Right. People walk into the bank and they're like, okay, here's my payment.
Right.
How much money will you give me?
Right.
And that hasn't changed, I don't think. We'll see if it changes with the coming generation. That part is a good question, but I kind of doubt it, because at the end of the day, like, the payment is really all that matters.
And there's the wealth transfer is going to help a lot. Like there is that, right? So all of a sudden that $2 million Toronto house is really $1 million, because you might be getting, a little bit of help from their parents, whether waiting for them to die or, they'll give it to you while they're still alive, whatever. Because that generation's been the biggest beneficiary of all this stuff, right?
Does your daughter listen to our podcast?
No, she does not.
Okay, well, you're lucky then. My kids don't, so they're not getting anything from me. We'll see. Long way to go on that front. Back to the bank. We're way off topic.
Back to the bank.
Again, how many cuts? And don't give me a cop out answer. You're not an economist. You trade. How many cuts?
You know me. Am I one to cop out very easily?
I told you. I gave you an over under, and you would give me an answer. On 1.5 cuts.
I think more than 1.5.
Okay.
I think, but it may take March to manifest them.
Do you think that long? Okay.
I would say Jan for sure.
Okay. I think sooner, personally.
Look, right now July's a 50-50.
As it should be, because it's going to be based on the CPI numbers.
But I don't think it can get much more than 60-40 in either direction until CPI.
Yeah, agreed.
Because I think there's enough, even if the data is really crap, we can't get to 75-25 until we see CPI.
The job numbers are going to test your thesis on Friday, probably, because I think they're going to be terrible.
Yeah, okay.
We'll go from there. But that's for July. So the other thing I think is worth highlighting, a couple things.
And also I'll say, like, September is already pretty much at one full cut. So
which is where it should be, in my opinion.
But to me, there's not a huge attraction to receive that stuff, because this is not the bank's not going to go on a program of 4 new cuts in spite of what Citi says. I just don't think that's happening. And I don't think just because they go in July, it means September's like,
makes it live,
right?
It makes it more likely.
Every meeting's live.
It makes it more likely. Once they have confidence in inflation, they are more likely to go at the subsequent meeting, I think.
But in every event, that inflation has now become so paramount, that number.
Yes.
That so you go down 1 month and up the next month, all of a sudden it's like run to the other side of the boat. So
I agree.
By definition, I think we've introduced a little more volatility on CPI days relative to other days.
Yes.
Which it happened last CPI day, but it doesn't always happen.
Yeah.
Right? But that's fine. Sure.
So the other thing I want to highlight is, it's a long time from now, but still, we got Q1 GDP last week.
Yeah.
It was better than expected. We'll get Q2 at the end of August, 3 weeks ahead of the September meeting, 2.5 weeks ahead of the September meeting. Because Q1 shaped up the way that it did, beating expectations, driven by trade, inventory moves, you are going to get a full reversal of that in Q2 and then some, probably.
Right.
Unless the street has learned their lesson, which they have not, the street being the people that forecast GDP like me. I would be surprised if it doesn't miss expectations by a decent amount and drive more dovish pricing of the September meeting when that time comes.
Right.
It also is, for the bank, they do pay a little more attention to that kind of stuff.
Well,
but
that's a big impact
they've already
to their
said,
model too.
They've already
right?
said that they know it's coming, though. So, but from a pricing perspective, something to mark in your calendar. Pretty decent chance of a miss on that front. And then on top of that, the wildfires in Alberta are going to be a potentially chunky negative for June GDP. Oil production, I think about 7% is offline. From what I saw yesterday, today is Wednesday the 4th, so on June 3rd, about 7% was offline. That's not going to be nice for the month of June.
Right. No.
June GDP will be potentially very soft because of that, which is not great for the second quarter. It's also not great for the third quarter. But if it only lasts for this month and then bounces back in July, I think that'll kind of offset a bit and actually might set the stage for a better Q3 at the end of the day. But it all still comes down to trade, and we don't know where that's going to go. And the new 50% steel tariffs do not help.
No.
Aluminum, I think the U.S. just eats that. I still don't understand those tariffs. They make no sense to me. So we'll see where we go.
Do you think the bank could use the tariffs as an excuse to claim inflation is kind of something they're willing to look through?
No.
They won't use that?
No.
Okay.
I think that, like, if they do that, I will be one of a great many people to shout at them that that's insane.
Well, do you think that they care about that, man? I mean,
Yes,
this is an organization that won't put out next year's OIS dates to make the market more liquid until August, even though, in spite of us begging them to do it for the last 3 years.
That has to do with scheduling problems. They do care what the street thinks.
Oh, please.
I don't know if they care specifically what I think. That I don't know about that one, but they do care what the street thinks.
Exam for the next 2 years, they can book their meetings for the next 2 years.
You let them know when those are, and they'll try to avoid them with their dates.
They feel about the same.
I don't think they can use that as an excuse to look through inflation because you risk second round effects and you risk destabilizing expectations. And all of this comes back to the fact that they made a mistake already.
Right.
And fool me once, shame on you. Fool me twice, shame on me.
I agree with that.
That's how businesses think. That's how consumers think. And that is where we are.
I agree with that. Although I will just say, coming out of today, I think they could have taken a slightly harder line because what's going to be reported tomorrow or yesterday after this gets dropped or whenever is the Bank of Canada wants to cut.
Yeah, that's fine.
Right? And they're not stupid. They know how the street's gonna. They know how the street's gonna read that, right? Like they know how the message goes. But look, I think it's a challenging time for the bank. I do. Yeah. I think they're between a rock and a hard place. That I don't really believe they have a single mandate. I think that no central bank could ever have a single mandate because it's just too omni-focused. It makes no sense. Like you can't really do your job if you don't have financial stability in the back of your head. All right, you can't, right? Yeah. I mean, that's the Fed's unofficial third mandate, and realistically, the bank has their second mandate is, you don't have to call it employment, but you have to call it, making sure the Canadian system works.
Yeah, they're cognizant of that, but that's what feeds back into inflation at the end of the day. It is. You brought up a great question earlier. If they effectively, how would they deal with stagflation? And I don't know. We'll find out. Maybe. I mean, I really hope not personally.
No one's had to in 30 years.
That would. Well, I mean, the destructive capacity of that would be really something. I mean, that's part of why we are where we are politically and geopolitically at this point. Sure. is on the back of that inflation surge, and I think it's clear to everybody that inflation is destructive, including central banks. And I think Macklem's alluded to that in the past. That we are where we are because of the inflation scare. And if it means that the economy needs to go through a tough period, then maybe that's what they're willing to put it through. And they would, at that point, I think you lean on the fiscal side. You say, our job is inflation. Right. Yeah. Your job is growth.
Sure.
You figure it out. We're not going anywhere. And if anything, this keeps getting worse, we're actually going to push rates even higher. So, I mean, maybe that's a bit of a long shot. And I think most people would probably say that I'm kind of full of it on that because we have never seen that with this generation of people. But
so you're saying
I wouldn't rule that out, man.
That the Bank of Canada could be the first central bank to actually apply the medicine after 25 years of refusing to apply the medicine.
Yeah.
Right? Because that's really what it is. I mean, we've had a history of, you run to mommy and mommy puts a Band-Aid on your knee and cuts rates to zero, right? I mean, it's been happening since Greenspan and whatever. And, maybe this is the time, if we do get a true stagflation, where you say we can't do anything, our hands are tied, and it has to be on fiscal. But then fiscal increases inflation, and then what happens? Let's just say that happens.
I agree.
Can the Bank of Canada stand there and say, well, now we have to raise rates?
We'll find out. I hope not.
All right. Well, again, that'll be
very much hope not.
Hopefully, we don't have that.
You won't still be in the market.
I won't be here.
You won't be in the market anymore by then. I mean, I may not be here anymore. We'll see. Joel, thanks again.
Thank you, Benny.
I always enjoy our conversations, and we'll have to have a final episode for you one day. I mean, whether it's this year, next year, the year after, whenever it is,
the year after. Let's keep it to this year, next year. Let's talk of the next 2 years.
You'll have to give me the inside scoop so we can have you on one last time. But in the meantime, I will keep you as a regular guest.
Thank you, and thank you for having me. It's been a pleasure, Ben.
Thanks for listening to Views from the North, a Canadian rates and macro podcast. I hope you'll join me again for another episode.
The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries. For full legal disclosure, visit bmocm.com/macrohorizons/legal.